The altcoin market contains thousands of tokens with market capitalizations ranging from billions to millions of dollars, each with a narrative, a team, and an argument for why their specific blockchain or protocol is uniquely valuable. For institutions expanding their digital asset mandate beyond Bitcoin and Ethereum, the challenge is not finding investment opportunities. It is filtering out the noise and applying a rigorous framework to identify the small subset of altcoins with genuine fundamental value. The historical data is sobering. Over 4-year Bitcoin market cycles, approximately 95% of altcoins underperform Bitcoin in total return terms. Many fall 95 to 100% from their peaks. Several thousand tokens have been created and essentially abandoned, with founders who collected funds and provided nothing of value. The altcoin market is an environment where information asymmetry is extreme, incentives for misrepresentation are high, and the absence of traditional financial disclosure requirements creates a due diligence challenge unlike anything in regulated securities markets. This does not mean altcoin investment is irrational. The 5% of altcoins that outperform Bitcoin often do so by extraordinary multiples, and a disciplined framework that identifies them before institutional capital flows in can generate asymmetric returns. But the framework must be rigorous, consistent, and explicitly designed for the specific failure modes of crypto asset investments. The 6-dimension framework treats altcoin evaluation as a structured due diligence process rather than a narrative assessment. Tokenomics quality is typically the first filter because poor token distribution can doom an otherwise excellent protocol to persistent price underperformance. When a token launches with 40 to 50% allocated to the team and early investors with vesting schedules measured in months rather than years, the sell-side pressure from unlocking tokens is a headwind that fundamental adoption gains may be insufficient to overcome. Protocol revenue is the institutional investor's closest analog to earnings for traditional equity analysis. DeFi protocols that generate genuine fee revenue from real user activity have a fundamental value flaw that purely speculative tokens lack. Comparing protocol revenue to market capitalization, the crypto equivalent of a price-to-earnings ratio, provides a relative valuation signal that can identify both overvalued tokens with narrative-driven prices and undervalued tokens with real adoption but limited marketing. Competitive moat analysis in crypto requires understanding network effects at the protocol level. A lending protocol that has accumulated the deepest liquidity and longest track record in its category has a significant advantage over a fork with superior code but no liquidity or user base. Liquidity is path-dependent and difficult to replicate quickly, making it one of the most defensible competitive positions in DeFi. The red flag checklist represents the distilled lessons from thousands of failed crypto projects since 2017. Anonymous teams with large insider allocations have been the single most reliable predictor of project abandonment and rug pulls. While legitimate developers have operated anonymously, including Satoshi Nakamoto himself, the combination of anonymity and large financial incentives for abandonment represents a risk profile that institutional due diligence frameworks must explicitly flag. Emissions-driven yield is perhaps the most insidious red flag because it is superficially attractive. When a new DeFi protocol offers 500% APY for providing liquidity, the yield is almost certainly funded by token emissions rather than real economic activity. The tokens being emitted dilute existing holders, and as they are sold to fund the yield, the token price falls. This death spiral, where falling prices reduce the dollar value of emissions, which reduces the attractiveness of providing liquidity, which reduces TVL, which reduces fee revenue, has terminated dozens of high-profile DeFi protocols. Concentrated token distribution is easily checkable on-chain and should be a standard step in institutional due diligence. When the top 10 addresses control 50% or more of token supply, those holders can coordinate to create artificial price appreciation followed by coordinated distribution to retail investors. This pattern, sometimes called a pump and dump, is illegal in regulated securities markets but largely unregulated in cryptocurrency markets. Quantitative valuation of altcoins requires adapting traditional equity valuation frameworks to the specific economics of blockchain protocols. The most robust institutional approach treats protocol revenue as the foundational valuation input, multiplied by a competitive moat score that reflects how defensible that revenue is, adjusted for growth trajectory, and discounted for tokenomics quality. Protocol revenue is the most important single input because it represents genuine economic activity rather than narrative. Uniswap generated over $1 billion in annualized fee revenue in 2024. Aave generated approximately $0 million. These figures provide a baseline for valuation analysis. At what multiple of revenue should a DeFi protocol trade, and how does that compare to the current market capitalization? In traditional SaaS equity markets, high-growth software companies trade at 10-30x revenue. Crypto protocols with similar growth profiles and revenue retention characteristics should be analyzable on similar metrics. The tokenomics penalty is the most crypto-specific adjustment in the framework. A protocol with excellent fundamentals but high insider concentration and aggressive emission schedules may be a poor investment despite its revenue because the structural selling pressure from token unlocks and emissions will persistently depress the price. The institutional investor must estimate the annualized selling pressure from scheduled token unlocks and compare it to expected demand growth to determine whether fundamentals can overcome the tokenomics headwind. Price-to-revenue analysis of DeFi protocols reveals significant valuation dispersion that creates opportunity for sophisticated institutional investors. Protocols with the most defensible competitive positions and highest revenue quality tend to trade at lower multiples than narrative-driven tokens with limited fundamental backing, creating a systematic value opportunity for institutions willing to do the analytical work. MakerDAO's relatively low price-to-revenue multiple reflects its status as the most established and revenue-generating DeFi protocol, analogous to a mature enterprise software company trading at a value multiple despite strong underlying fundamentals. Newer protocols with higher growth rates but unproven competitive moats trade at higher multiples, reflecting market expectations of future growth that may or may not materialize. For institutional portfolio construction, the price-to-revenue framework provides one input into position sizing decisions. Tokens that are cheap on revenue metrics relative to their competitive position and growth trajectory represent larger position opportunities. Tokens that are expensive on revenue metrics relative to their competitive position and growth trajectory warrant smaller positions or avoidance. This systematic approach reduces the influence of narrative and marketing on capital allocation decisions. The institutional altcoin due diligence process should mirror the rigor of traditional private equity or credit due diligence, adapted for the specific information availability and risk factors of crypto assets. A minimum 6-week process allows sufficient time to gather and analyze the full range of on-chain and off-chain information required for a responsible investment recommendation. The legal and regulatory review in week 5 is non-negotiable for any institution operating under securities law. The question of whether a specific token constitutes a security under the Howey test is a live regulatory question, and the SEC's enforcement actions against multiple token issuers have demonstrated that tokens traded on crypto exchanges can be found to be unregistered securities. Institutional legal counsel should assess this risk for any material altcoin allocation before investment. The governance review deserves more attention than it typically receives in institutional altcoin analysis. A protocol with excellent fundamentals managed by a governance structure dominated by a single insider or venture capital firm is subject to governance risk that could result in adverse protocol changes affecting token holders. The history of DeFi governance attacks and insider-dominated protocol modifications provides ample evidence that governance quality is a material investment risk factor. The altcoin evaluation framework is not about finding the next 100x token. It is about applying institutional discipline to a market where the absence of that discipline has cost investors billions of dollars. The protocols that survive rigorous fundamental analysis, demonstrating genuine revenue, defensible competitive positions, quality tokenomics, and credible teams, are the ones most likely to generate sustainable long-term value. For institutions expanding their digital asset mandate, the practical implementation of this framework requires building internal crypto research capability or partnering with specialized research providers who can conduct systematic protocol analysis. The investment in research infrastructure is not optional. The information asymmetry in altcoin markets is simply too extreme for generalist analysts to navigate without specialized tools and expertise. The most important meta lesson from altcoin investment history is that narrative quality and fundamental quality are negatively correlated in crypto. The tokens with the most compelling marketing stories are often the ones with the weakest fundamentals, because teams with weak fundamentals need to compensate with strong marketing. Institutions that learn to resist compelling narratives and demand fundamental evidence before allocating capital will systematically outperform those that follow market momentum and community enthusiasm.